Hello, everybody. How are we doing today? So, I got a question for you. Do you lie awake at night wondering if your credit score is secretly plotting against you sometimes? Are you ready to unravel the secrets of a credit and uncover the tricks to unlocking the perfect credit score? Well, folks, fasten your seatbelts because we've brought in the ultimate credit mastermind for this milestone 70th episode. So, welcome to the Texas Real Estate and Finance Podcast, where we unveil the keys to financial empowerment one episode at a time. I'm your host, Mike Mills, a mortgage banker in the heart of Dallas-Fort Worth, and today we are diving deep into a topic that affects every aspect of your financial life, your credit score. Now, before we unmask the hidden hacks of your credit report, a quick reminder, if you find value in these conversations, please don't forget to hit the subscribe button on your podcast platform, or you can check out my YouTube channel at Mike Mills Mortgage and Finance for more content. Subscribing guarantees that you never miss out on information that could help you take your real estate business to the next level. Now, our guest today isn't just a credit expert. She is a bona fide credit ninja, Jedi, master, or whatever superlative you want to use. She's got a staggering 35 years of experience in the mortgage credit arena, and she is here to share with us her wisdom and reveal the hidden treasures of the credit scoring universe. I'm thrilled to welcome Sue Buswell to the podcast. Sue, how is life treating you today?
Hey, Mike, it's great. I am kind of wondering, though, if there's somebody else supposed to be joining me with a cape on because I don't have one. So thanks for the great
Hey,
intro.
I gotta hype you up. You know, we got to make sure that everybody look. I promise you, your Jedi Ninja master skills are 1,000 times more than the average person that's going to be listening to this. So you're going to help out everybody with this, and I think this is one I'm really excited about because I think you got a ton of information that my audience will really find valuable. So now you sent me a bunch of great information, and we're going to go through how it affects mortgages and the changes with maybe with the FHFA and all that stuff. But I want to get started with some simple stuff first. We're just going to kind of ease our way into this a little bit. How did you become a credit ninja? So was it like a Bruce Wayne thing, like Batman, or something similar? Like how'd you get to where you're at?
Yeah, so I was actually going to pull out my copper judo medal from when I took third place at state just to share that I do have some background in martial arts, but
Yes.
really it started back in 1985, and yeah, we didn't have FICO scores at that point, but I learned about the credit system because I went to work for a TransUnion bureau, and that TransUnion bureau back in those days did a little bit of everything. So I was hired into their mortgage department, learned the business from the ground up, and in 90s, 95, when FICO came into our market, I was ready to learn about the system, but no one else understood it, and there was still no explanation. So, me being someone who's not afraid to ask, what the heck does that mean? I picked up the phone and I called FICO and I said, I need to understand this because I can't keep telling my customers, nobody gets it, you just have to have it.
Right.
Right. So anyone who was in the market back in those early days, they remember that. They're like, I had this guy approved 2 weeks ago. He doesn't have a score. I can't do a loan. Right.
Wow.
Those were tough days.
Yeah.
So I learned it from the ground up, and I learned it from, I like to say, the inside out. And I've always been a strong proponent of empowerment through education. So I taught my team. Credit Expert came in the market in the 2000s, but we were analyzing credit reports and helping people make the right choices to, pay down debt or dispute something or whatever they needed to do to improve their score before we had such a great tool as the Credit Expert tool. So anyway, that's it. I say 35 years, but I had to tick a few more on there, Mike. I was 12. I'll just let all your
You
viewers know I was 12 when I started. It was forced child labor.
you were a credit scoring you were credit scoring creative or credit scoring expert before it was cool, right?
That's
You had it
right.
before
That's
everybody
right.
else got there. Yes.
Yep, that's right.
So all right, so you were on I don't want to say the enemy side because TransUnion's not an enemy, but it's certainly credit nobody it's nobody's like favorite topic as far as like diving
Right?
into it, but it is something that we all need to have and that we all need to know, and that's the important thing is that everybody needs to be conscious of what they have and what they're doing, and that's why I really want us to kind of highlight some basic stuff when it comes to credit. So let's start with, if you were a parent, if you were talking to a kid that was starting out with credit, we'll start from a clean slate, and we'll kind of work to, if things go sideways, what we can do. But what would you suggest to, I'm a parent, I have two kids. I have a 16-year-old and a 14-year-old. And, we've already started financial education. We work through budgeting and saving money in accounts and all that kind of stuff. But when it comes to credit, what would you suggest would be some best practices starting off to kind of build your credit up?
Well, it's kind of interesting. So when I was raised, right, my mom was a bookkeeper, so she knew about budgeting and managing money. My dad owned a business, so what we had was what we call a chore board, right? So
Uh-huh.
so if kids are doing chores in your house, they can choose which job they're going to do and how much money they're going to earn from it. That was my first experience.
Okay.
But if I found, a precious that was more than I had earned that week, then I could do extra work or I could get an advance to buy whatever the item was that I needed to have. But then I had to work to pay it off. I didn't get another allowance, right? So I think those were really, really early lessons for me. When you're 9 years old, and you've bought your little precious whatever it is that you had to have, and then you can't get anything for another 2 weeks because you're basically in debt. And
Right.
they've got their hand out going, no, you owe me, you owe me for that. So take that to today's world, right? We're grown-ups. We've got to have, that was how I learned about credit. I had to have something, or
Right.
I thought I had to have it. So those lessons can start really early. And then there's a lot of things out there now. There's apps. I think it was something called a green card or chime card. I don't remember what it was I saw, but these are apps that help parents work with their kids. Like, here's your you did this chore, you raked leaves in the yard, so you're going to earn $50. Oh, I want to buy a bike. Okay, well, now that's an opportunity to teach. You're fortunate because you're in the finance space, so you
Yes.
know to teach your kids that.
Yeah.
But we really have to make sure that we're serving all the people who aren't in our space and
Right.
don't understand those lessons. Where do I go to get it? Right. So TransUnion, Equifax, and Experian have great sessions and sections and information on that. And I think those are great places, but your schools aren't teaching it. That's
Yes.
unfortunate. We're not getting it in school. We don't, I think I learned how to write a check, but I already knew how to do that from my mom. So, I mean, with your kids, where are you looking besides what you know? What do you see as a parent that's helping you teach your children?
Well, we actually have, I started this several years back. I've done a couple videos on it actually. There's an app called Busy Kid. And what it is very similar to what you were saying. I go in as the parent and I create certain amount of chores, and I assign a dollar value to those chores. And actually, when they were young, what I did was I would give it like if they were brushing their teeth, for example, which is something that you got to teach your kids to do when they're young. They would get 25 cents for brushing their teeth that morning. Now it was stuff that they need to be doing, but they're young, and so. But the idea is that they would have a task that they would have to complete. They would then complete that task, but then they also had to go into their app on their phone or iPad at the time. Most of them, they didn't really have phones; they had iPads. They would have to go into their iPad on the app, and they would have to check the box that they brushed their teeth that morning. So it was giving them a level of responsibility to not only do the task, but then also acknowledge that they did the task. And then at the end of the week, they would get paid out essentially into their
Mhm.
account. And they had it at that time, or they still do have debit cards. But when they were little, we didn't really do the debit card thing because there was, they're not rolling to the grocery store needing to buy something. So, but they could see how much money they had in their account. So if they wanted to buy something at the store, get a candy or a toy or something that we didn't, wasn't our responsibility as parents to provide, essentially, that was anything extra that they wanted, then they had their own money to spend. So they had to learn what the cost of things were, and how much. Well, I only got $20 this week and I just spent $5 on this. That doesn't leave me a whole lot of money left over.
Mhm.
And the other cool thing about that app is it has 3 sections to it, where it has your spend, it has your savings, and then it has like an investing section where they can actually buy stocks and stuff if they want to. So
Wow.
it's really cool because it teaches them a lot of good habits. It doesn't really get into, I guess you don't want to, we were talking about this before we got on. Debt is not something that we want to
Mhm.
encourage people to get into, right? Because credit is really all about applying for debt. And if you're applying for debt, we're going to look at your score. What is your history of paying debt, right? What have you
Right.
done in the past?
Right.
And so we don't really want to encourage our kids to get debt, but at some point it is a necessary evil, like we were talking about with houses, especially with what we do. People
Mhm.
don't just have $400,000 under their mattress that they can just drop down on a house. Most don't. So
Right.
there is a point where you do need it. But do you think as like a 18-year-old, 19-year-old, because I ran into this in college when I first went to college, to Texas Tech, and it's been a long time, but it was like 1997.
Yeah.
When I showed up there at the freshman orientation, there were literally, I mean, I don't know if there were hundreds, but 20 or 30 booths with, MasterCard, Visa, every single credit card you could possibly imagine. And they were all giving away t-shirts and gift cards, like, just encouraging you to sign up. So do you think, and I think we've gotten away from that as a society, but do you think nowadays, if I take my daughter and, should I get her a credit card at 18, or should, and teach her how to manage it and use it? Or what are your thoughts on that?
Yes, I think you should. But I think just like you've taught them responsible management of money, this is just an extension of it.
Right.
So take those lessons that you're teaching them about responsible management of money, and now you can do it with credit. So let's say they get a $500 credit card, okay, and
Okay.
they're going to go out and put $500 on it, right? They need to understand the interest. They need to understand that every time they make a $50 payment, $30 of that payment's going to somebody else. It's not
Right.
paying off who they borrowed the money from. It's going to someone, especially at today's rates. It's
Yeah.
going to somebody else. So here's how I like to think about credit. It's a necessary evil.
Mhm.
You have to have it, and you can't get it unless you have it.
Right.
So, right? Can't get it
Yep.
unless you have it. So we have to understand the rules of the game, and then we have to learn how to play the game so that we're the winners, not the creditors.
Right.
So if someone's offering me a credit card and it's 0% interest, I'm probably going to take advantage of that if I have credit card debt
Okay.
that I need to manage. But I'm not just going to flip my credit card over there without having a significant look at my budget,
Right.
something you and I were talking about earlier, and saying, am I simply buying time? Am I taking on debt to get out of debt? Like, does that even make sense when you say
Right.
it out loud, right? I'm in debt. I need help getting out of debt. So I'm going to take on more debt for the hope that I get out of the debt. It's like, no, right?
Yes.
And you had a conversation with an applicant where you were treating them as a human and having a real conversation with them saying this may not be in your best interest.
Right.
I think in our industry right now, that's what we need to do. It's difficult because everyone's hurting in this industry with the drop in business. But if we do that in the right way, we're not only helping someone right now, we're teaching them lessons that they maybe can teach their entire family.
Yeah.
So credit is necessary. You have to have it. But if you are playing the game in the right way, then you're getting the benefit of the credit. And the people at the top of the credit pile, they're using other people's monies to build their fortune.
Yes, they
So
are.
once you learn that trick,
Yep.
that's what you can do with credit is use someone else's money to build your fortune, then you can do that successfully.
Yeah.
So,
So these days, credit monitoring systems or softwares are all the rage, whether it be freecreditreport.com or MyFICO or whatever. There's a bunch of different ones out there. So, what are your thoughts on those? And is it important for someone to have that? What companies would you recommend? And then also, what type of habits or practices would you advise into regularly checking on that to monitor it?
So we all know during the pandemic, during COVID, there's annualcreditreport.com. If you don't know
Yes.
that, you should know that website, right? So
Yes.
annualcreditreport.com, you can go there. It used to be to every year and get a free credit report from TransUnion, Equifax, and Experian. Don't buy the score. You don't need the score, right? You need your credit report.
Yep.
So now they're offering you a free credit report every week.
Oh, is it
Credit
every week
monitoring,
now?
it's every week now.
Yeah, I knew
Yeah.
they had changed it during COVID, but I didn't know if they switched it back. Okay, yeah.
No, they're back to every week, so it's no charge. I honestly don't want to look at my credit report every week. I don't think it's necessary.
No.
I did sign up for credit monitoring, a credit journey, and I did a credit card on one, which is Vantage 3.0, and then I did my credit union on the other, which is interestingly it's FICO Auto Score 8. So it's but my point my score is 1 point off on those two models.
Right.
So, get something that lets you know what's on your credit. If you've never pulled your credit report before, start with annualcreditreport.com, pull your credit report, and just review it. Are
Right.
your creditors on there? Right? Is your name, address, and social correct? Right? Those types of things. Look at the basics. And then look at whether or not your creditors are reporting information in the right way on you. And that means that the date you open the account is accurate and the balance and limit, all those things are accurate. And then look at it. I would say once a quarter. What I used to recommend is in the spring pull one, in summer pull another, and then in the fall pull the third one. That's when we only got one free from each of the repositories.
Right.
I'd say the majority of creditors are reporting to all three agencies at this point, which, future conversation that we're going to have about the FHFA changes coming. But there are areas, and if you live in a rural area, that the types of creditors there are probably not reporting to all three bureaus. So, use annualcreditreport.com. It's free. Get it. You can get your credit report right online. And as far as credit monitoring, if that's what you're moved to do, I've never monitored my own credit after 38 years. I just simply picked this up. I was like, oh, let me see what this is about. Let me see how different my scores are across the spectrum, because I don't think they're that different. And they weren't. They're not. So I think that's one thing people should do. The other thing is take advantage of credit, right? If it's 0% interest on something and you can pay it off in that time, then use that money to purchase whatever it is you're looking at purchasing, and take advantage of that money. But don't keep taking on debt to get out of debt, like I said earlier.
Yeah. Now, on the monitoring piece, I get this as a mortgage lender, because I pull people's credit every day, and
Right.
they will say, okay, well, on freecreditreport.com or Credit Karma, my credit score is 695. And
Right.
then I pull their credit score and it's a 650, okay, or 640 or something along those lines. Can you explain to people the differences between credit modeling and scores based on what type of industry is pulling? Because I think there's some confusion there when they see their credit score online. I call it their consumer credit score. I don't know what you call it. And then the other ones that kind of fall into place too.
Yeah, so back in the day, I used to call it the difference between a FICO and a FACO, but we can't really
Right.
do that anymore. So
Right. Right. Right.
I can say I used to say that. I don't
That's
say
right.
that. But there are big differences, and there's differences within the FICO models. And here's the one thing that I think most people don't understand is mortgage lending exists in a completely different credit world than most other kind of lending. So there's
Right.
that. There's two major players in the credit scoring world. There's FICO, which is Fair Isaac Company, and there's Vantage Score. So those are the two. Now, every lender has some sort of an in-house credit scoring system. And then there's a few other credit modeling systems out there. But the two that you're going to run into are either FICO or Vantage Score. And Vantage Score and FICO are similar but not the same. And what happens with the FICO score in the mortgage space, these models originated in 95, were updated in 98, and had their last, I would say, major reconstruction, if you will, in 2004. So we're using very old credit score models, which is why our mortgage industry is going to be upgrading their credit score models. Yay. Sue knows.
2004, that was the last time they upgraded the or updated the model.
Yes. So, well, they make little tweaks to it, but those models are over 20 years old, Mike.
That's crazy.
Yeah. So they make little tweaks, like things that happen within National Consumer Assistance, where all the, public records had to come off. And then we've had the changes with medical debt. All of those changes that have happened have been written into that. But then there's another thing that FICO scores that they do. Experian has their own model. TransUnion has their own model. And Equifax has their own model. So what does that mean? You've got FICO scores that have differences at each of the repositories, which is why in our mortgage market now we pull a tri-merge,
Yep.
right? We toss out the high, we toss out the low, we go with the mid score, trying to be fair, right? But if I were trying to explain to a consumer that pulling my credit report today is not going to impact their credit report, but then they also go and talk to someone about a HELOC that's going to use a FICO 8, that's going to be the same conversation that we started this question with, which is, I got a 695 or a 650, because the models are different. They weigh information differently. They put different amounts of importance on things. So
Yeah.
in the mortgage market, mortgage inquiries are ignored for the first 30 days that they're on your file. And then there's two different periods of what we call deduplication, which means the same. If it's a mortgage inquiry, meaning it's a mortgage company, it's going to be either 14 days with Experian, or it's going to be 45 days with the other two, with TU and Equifax, where it's duplicated, the same type of inquiry.
Right.
But a HELOC inquiry is not a mortgage inquiry. So if the borrower did both in the same week, they'd have two hard inquiries.
Gotcha.
So it's the model, it's the difference in how it's calculated, and it's the difference in the level of importance that's placed on information in that credit score. So in our current FICO models, and stop me if I'm going too fast for you here, Mike, but in our current FICO models, and in most of the FICO models, 35% of your score is your payment history. Like, what have you done and how have you done it, right? And there's also a what have you done lately component, because
Yes.
it's looking at your entire history, but the more recent to the date of the credit report, the date of the delinquency or the issue is going to carry weight in the score. So that's number one. 35% is what have you done and how have you done it.
Mm-hmm.
30% is how much debt are you carrying specifically on your revolving accounts. Installment loans are in there, they're factored smaller, but 30% is what's your balance to limit. Most people want to say 30%. That's relative to the next category, which is the length of time you've had credit. That's 15% of your score.
Okay.
You and I chatted about that a little bit before the call, and I said, I'm at this is the benefit of aging, guys, right? Your score goes up if you do things right. So
just stick around. Your score will get higher.
yeah. Sometimes there's just nothing else you can do but just have a birthday, right?
Yeah,
So every
yeah,
birthday the score goes up, right? So I've got a Vantage score 3.0 of 829 and a FICO score of 830, right?
right,
So, that's just bragging rights when you get
right.
there.
Yeah, your badge of
That's all
honor.
that is.
Yes,
That's
yes,
bragging rights, right? Now, in my 20s, it wouldn't have been that way, right?
right.
That would have been my scores. Okay, not at
Yes,
all.
yes.
So that 15% category, that can really be a deal breaker. So let's go back to your college, age kids. Get a card.
Mhm.
And mortgage underwriters, don't listen to this. You guys just like put it on mute for a minute. Use an authorized user account to get that length of credit history, to establish your credit, and then start building your own history and profile, because that 15% can be a huge deal breaker. And we've
Yeah.
got two other categories, but I want to stop and make sure I'm not rolling too quickly and you have a chance to ask any questions.
No, no. The way that I explain it to people, and you can tell me if this is because I always have, like again, doing mortgages for 13 years, we have a spiel, it's all the same stuff we say. So one of the things that I tell people when I get that question, because I pretty much get it every single time, just about, is when you look at the consumer credit score, which is what you get from my FICO or even directly from, because they'll say, well, no, I get it from Equifax. I'm like, well, you're getting it from Equifax, but it's still your consumer score. It's just kind of like a rough estimate of where you're at, right? At a given period of time based on your accounts that you've had, it's, and what I do tell them is like, look, somebody is paying for that score. Okay. It may not be you. It might be your bank. It might be some other service, but somebody is paying them for that score. So if they're getting paid for that, I would think that they want to give you a more rosy picture of where you're at. If you think that you're a 640 credit person and my FICO is telling you you're a 660, then you're like, all right, I'm doing great. Like it's positive reinforcement to continue to pay for a service. But when you look at cars and credit cards and automobile or in mortgages, you're going to get different scores with each one. And the
Absolutely.
reason being, part of the reason is obviously the models matter, but in simplicity or for simplistic terms, what I tell them is like, look, on a car, for example, if somebody pulls your credit score on a car, it's probably going to be higher if you haven't had a bunch of repossessions and late payments on cars, because it directly affects that industry more. But if it's just been your average type report, then your score for a car is probably going to be higher than your score would be if I pull a mortgage. And part of the reason for that, or the justification for it, is with an automobile, if you don't pay that debt, if you don't pay for your car, the bank or creditor can just come take it, and they can pull up in your driveway, they can hook it up to a tow truck, and they can drive away, right? So the ability for the creditor to reclaim that asset is relatively easy, because if you don't make the debt payment, then they can take their asset back, asset being in quotes for a car. But for a house, if I pull your mortgage score for a credit for a mortgage, if I pull your credit score for a mortgage, that score is going to be probably lower than your car, because in order for the lender to reclaim that asset, if you don't make your payments, it could take years. It could take lots of money through the foreclosure process, and so the risk level to the credit, or to the bank, is at a much greater level. So therefore, the report scoring is maybe weighed a little bit heavier, because they want to really be sure that, that they're safe, essentially, to lend this money in this situation. What do you think of that explanation? Is that good or
So
bad?
I
Flawed.
probably simplify it a little bit, but you
Okay.
hit on something really, really great. Number one is this is a risk predictor. That's all a
Yes.
score is. It's
Correct.
a numerical number assigned to what is the likelihood that we're going to get paid back. Now, this might be like mind blowing to your viewers.
Right.
Our mortgage models do not put a focus on mortgage payments.
Okay.
Okay.
All right.
That's coming in the new models.
Okay.
Our mortgage models today are looking at the likelihood that you will default on any account in the next 2 years.
Okay. So that's kind of are you
It's,
going to default? That's really the question.
are you going to default? And it's not focused on mortgage, which is why we have all of those other underwriting guidelines and all those things. And the score is kind of our litmus test. It's where we're going to
Yes.
place you, right?
The barriers of
And then
entry.
everything else has to come into play to make it work. So
Right.
very strange, right? When you think about that there's no one looking at specifically, it looks at all debt, but it's not specifically looking at mortgage debt. So
Interesting.
Vantage Score 4.0 will be doing that.
Okay.
And the FICO 10T with the trended data. We're going to see a little bit more, we're going to see more predictive scores, which is going to, when you increase the risk factor for your lenders, you lower the cost of credit, right? That's one of the reasons why we have
Yes.
higher interest rates right now is it's a very risky market.
Yep.
Interest rates are going to rise with risk and they will lower with risk. So I think our new score models will provide a better risk predictor, because could anyone have predicted that someone with a 775 score in our 2008 year would just stop paying on their house and do a strategic default?
Right.
No,
Yeah. No.
no. Our score models were not going to
But they
look at
did.
that.
Right.
A lot of them did, yes,
Yes.
and we're hoping we don't see that ever again.
Yeah.
But that's the thing. I mean, I guess that's kind of some of the secrets that we talked about, the secret sauce, right? Is our current score models in the mortgage industry are really pretty basic, right?
Yeah.
It's what have you done over the last 2 years to determine what will you do in the next 2 years, and then there's those 10 scorecards, right? So it's not just three scores, three models, three customizations. There's these 10 scorecards, and if you do this, you could move from that scorecard to this scorecard, right?
Right.
There's more behind the curtain in that, but when we come down to it, at the end of the day, what everyone's looking at is make your payments on time,
Right.
keep your balance to limit low. If you don't have a length of credit history, don't, I mean, I did this for my little brother. He was moving into an apartment. I put him on an authorized user, made sure the creditor reported. He doesn't get a card. This is Sue knows a score. She's not sending him a credit card, right?
Right.
So
You're not giving them the ability to charge. You're just saying,
no,
"Hey, I'll give you a little bit of my
it's like
history.
all
You
my
can have it."
deposits and everything you didn't mind, did you? Right? No, we're not
Right.
doing that. But he got his own, got into the apartment, had a great credit score. Now he's gone on to establish his own credit. So he's now building his own credit. And, we were talking about your kids. This is a 50-year-old. This is someone who never learned the lessons of credit growing up with a sister in the credit system. But that's a whole family thing. We won't get
Yeah.
into that one on today's call.
Well, hey, look, it's kind of like you can tell your friends all kinds of stuff, and you can tell your clients, but good luck trying to tell your family or your spouse anything, because you're
That's
the
right. Yeah,
dumbest.
they're going to go ahead and take it from a stranger before they ever listen to you. But
Yeah,
now we're on the right path and getting him ready for that home ownership. So, when he's ready to buy, when interest rates have normalized and home prices have come down to where he can afford them, because we have those affordability conversations a lot,
yeah,
he'll be ready credit wise because he's making all the right steps to build his credit. And I think you said this at the beginning of our conversation. It's about empowerment, right?
yes,
If we can empower people from teenage, right? From grade school into college, into adulthood. I was at the Next Mortgage events in Dallas just a few weeks ago and had a little impromptu, like, when did you learn about credit? And here are some of the smartest women in mortgage banking with me at this event. I'm not outing anybody, but almost everyone there didn't learn about it until they had to learn about it through the School of Hard Knocks. Like, how do we pull ourselves out of that
Yes.
college debt,
Yeah.
right? So we have to do better as an industry and as a society on how to teach people about credit. It really starts with pull your credit report,
Yeah. Well,
understand the scoring systems.
Well, I think it's a generational thing to some extent because, and I've had this conversation with people over the years many, many times, but I'm Gen X growing up. And so my parents are boomers we've kind of gone through when I was growing up as a kid. Look, I had everything that I needed as far as like, I had a roof over my head, I had food on the table, all that kind of stuff. I got taken to school. There wasn't, life wasn't hard. Okay. Like it was pretty good, but there wasn't very much. It was kind of like, if I were to ever ask my mom how much money she made at her job, she would look at me like it's none of your damn business. Like, why would I ever tell you that? Or if I were to, what's your credit? Like there was zero conversations about finances, zero conversations about money. Oh, and the only conversations were, you can't have that. It's too expensive. Stop asking. That was about the extent of it. And really what because people from my generation that complain about that, I go, well, look at what their parents did, because their parents just put them in the corner and said, shut up, don't say anything, and we'll get to you if we need you. But otherwise you don't get to have a say. Be lucky that you have food. Right. So we're progressing as a society. We're moving along. And now these days, like with my kids, and I think a good chunk of the population, or at least, and I hate to say the educated population, but college graduates, people that have been through the system, essentially, we are trying to
Mhm.
educate our kids as much as we can on the financial system. And especially since 2008, when everything came crashing down, you see a whole wave of millennials that were, in their teens at that point, and saw their parents go through the struggles of dealing with their losing their 401k or losing their jobs. And then they had this lifestyle with these McMansions and all these cars and stuff, that there was all debt to the hilt. And they looked at it and they went, I am not doing that. Like, whatever it takes, I'm not going to do that. So I do feel like overall, that it's getting better, right? It's not where it needs to be, but it's certainly getting better. And I think those factors have had an impact, just generationally speaking. And then
Right.
being the fact that we went through that great recession back in 2008.
Yeah, I think you're right on there. I think that we've got technology, right, that we didn't have. I mean,
Yeah.
you and I talked about this early, in advance of the cast, but back in the 80s, it took 15 days to get a what they called a residential mortgage credit report out of my office and into a lender's hands. So,
Yeah.
hey Mike, can you give me a prequal letter? Yeah, come back in a month.
Right.
I can give you a
It's just,
prequal letter, right? Yeah.
yeah. Well, that's how everything was back then. That's just how it is. We
Yeah,
can't
but
imagine
now
that
we've got
anymore.
all this great technology and we've got more information. We have TikTok, and we have YouTube, and we have X, and we have all these great places and Spotify where these podcasts will go, that we are informing the next generation. And I think they did see that, right? I'm seeing a lot of people in that Gen Z group coming out and saying, now I need to know this, and I need to know how to, what I was saying earlier, how to play the game with someone else's money so I'm not
Yes.
living in debt,
Yeah.
right? I mean, the
Absolutely.
best feeling I've ever had is when my husband and I were able to say we're debt free, right?
Yeah.
We use our credit cards for points. They're paid in full every month. And God willing, we'll never have to worry about making another house payment, car payment, what have you. We're not rich by any
Yeah.
means,
Yeah.
but it was home ownership, and it was continually moving up through home ownership. My first home was like 16% interest. So,
Yeah.
don't be
But it was
afraid of it.
also $70,000.
It was a little more than that, but
Yeah. Yeah. Yeah.
yeah, but you know what I mean. Yeah. So today, if you're looking at 400,000 and an 8% interest, are you
It's a
going
lot.
to have a little bit of pain? Yeah, you probably will trying to make that payment. But you have to look at whose pocket is the money going into, and every opportunity that you get to put the money in your own pocket from strategically using credit, that's a smart move. And I
Yeah.
think that comes with us telling people, like, how do these things work, right? So great question. And I'm going to go ahead and just say that, does paying credit, your credit card in full every month help or hurt? It helps. And when our new score models come out, especially in the mortgage market, guys, they're going to be using trended data, right? So if you're in the mortgage space, you know that trended data was something that, as a mortgage lender, Mike, you had an option to see it, um, or to not see it, or to, underwriters might want to see it, or what have you. But they're now going to put that trended data into the score model. So what does that mean? With revolving credit, if you're a transactor, or a revolver, right? So what
Okay.
does that mean, right? A transactor is someone who's paying their credit card in full every month, right?
Mhm.
So I look at my credit card balance probably every week, and my full statement balance is paid in full every month. Now, on my trended data, that's going to show, and I think about this in the way of American Express, right? Everyone in the mortgage industry stresses over American Express because those are business cards. They might be 20,000 limit and a 20,000 balance every month, but they're paid in full every month, right?
Yep. Yep.
Today, that could be an issue in our credit score. Not with the new models, because
Okay.
trend data is going to be showing that you're paying that. Yeah, it might be 2020, right? High to limit, that ratio. You'll notice in the Vantage score, and I think I sent you that chart, but Vantage score puts credit utilization at a different level than FICO models do. So that's our FICO score. That's kind of what we were talking about with the 35, 30, 15, 10, and 10.
Mhm.
But with our trended data, FICO keeps this all the same. It doesn't change. But you're going to notice that in your amounts owed and in your payment history, those types of things, that trended data is going to start being calculated. Vantage score sliced the pie 6 times, if you will, and they put more, emphasis on late payments or payment history. I think it's 41% of our FICO score, of our Vantage score, is history. And then credit utilization is lower than 30%. But that trend data, if you're a revolver, you could be paying on time every single month. You're only paying the minimum payment. Your transactors are going to have a higher score than your revolvers. And that's something that comes into play with our current models of FICO. So we talk about that 10%. There's 2 10s in our current FICO models, and they'll be in the new FICO models in the 10T. One of those is inquiries, and we'll save that one. The other one is types of credit, and this is overlooked a lot. And Mike, I've had conversations with guys in your desk, this guy's got great credit. He's got great credit. How come his score isn't higher? And I'm looking at the credit report with you, and it's because he has all tier 2 credit.
Okay.
So
What's tier
what's
two
tier 2
credit?
credit, right? Like
Yeah.
tier 2, okay. Tier 1 is bank, credit union, major MasterCard, Visa, Discover, Amex.
Okay.
Okay. Tier 1,
The big boys.
the big boys. Tier 2, finance company credit. Okay. Department store credit cards. You can be making all your payments on time, low ratio. But if you put a tier 1 credit next to a tier 2 credit borrower, all things being the same, tier 1 will have a higher score every time.
Really?
So you need a mix. You need both. You need both finance company and major credit cards.
Mhm.
So let's take a
So
look at this new
yeah,
question if
Brad's
you
got
want to
another
look at that.
question. Go ahead. Read that off
Yeah.
there for me.
So paying that credit card every month, but someone pulls your credit with a big balance. So it depends on the model, Brad. That's a great question. When we get Vantage 4.0 in the market, Vantage 3.0 is already calculating it this way. So I know you can get Vantage 3.0. There's some, FinLocker is one that's what they're using, and they support the mortgage industry. They support credit counseling. They support a lot of industries with their system. But that big balance could hurt in relation to your credit report, because today's score models are a moment in time. It's what's on your credit score at the moment the score is pulled. Let me give you a better example of that. We can do it with credit cards, but I'd like to do it with a derogatory item. Okay. So I had a lender contact me. His customer was pre-qualified last month, missed a credit card. They'd moved, missed a credit card payment, 30 days delinquent, brand new, right? So when we talk about that 35%, the biggest chunk of our FICO score, right? It takes in your payment history, and delinquencies are big. And when you look at delinquencies, there's 3 words behind delinquent that you have to be aware of. And that's recency, frequency, and severity. Okay.
Okay.
So how recent was the late? How severe was the late? And how often, how frequent is this consumer late? Okay. So this was a brand new late date. They pulled the credit report the middle of the month.
Mhm.
Timing is important. This is a really great nugget, guys.
Really?
The time that you pull the credit report is important. They pulled this credit report the middle of the month. The late date was already reporting, and it hit his score.
Mhm.
The date reported on that particular late date was the same month the credit report was pulled in. So October 2023, date reported October 2023. I told the lender, pull the credit report on November 1. He's like, why? I said, because they won't have reported yet. They're not reporting this information until later in the month. So if the late date is genuine and it cannot be removed and there's not a courtesy deletion option or any of those types of things, right, happening, then pull that credit report the 1st of November. What will happen is your credit report date is November, your delinquency date is October, and you will have a score increase because of that. It's
Okay.
not going to increase. So timing is huge. And I don't think that we talk about that enough. But
No, I
the
didn't
date,
know that at all.
yeah, and you can see on your credit report, you should be able to see the month and the year that someone reported. So let's go back to this question that Brad had about the balance. Same thing, right? If the balance got paid off, but it just hasn't reported yet, just re-pull the credit report the next month. Because right now, our scores are very much tied to that moment in time. When the trend data comes in, we're going to get a little more grace with
Yeah.
that, right? So if it's a big balance, but it's always a big balance is paid off, you'll get grace because of that trend data.
So I was always under the impression too, though, that the credit card, speaking of credit cards specifically, that if your bill shows up at your house on, say, the 10th, right? Well, then the credit card company probably reported it to the 3 credit bureaus on, say, like the 8th or the 6th or whenever they mailed it out. Essentially, it's kind of so. So if you pay it off in full, they're only going to report once a month. So if you recharge it again and then pay it in full, so every single month you're going to show a balance because every time they report, because they only report once a month, right? Just one time.
Most of them do. Some of
Most
them
of them.
report more than once a month. Yeah.
Okay.
So,
Okay. So
and you can see that. So you can actually see that on your credit report. And if you use the credit expert tools, which is specific for mortgage. So for those people that are tuning in that maybe aren't aware of that, that's a tool that's available to the mortgage industry.
yeah,
You can actually see the date of the reporting. So you can see that it's October 13th that they last reported, which means the next time they'll report is likely November 13th.
right.
So that date is important, but until we get that trend data component into our credit scores, carrying a balance can affect you if
Right.
that balance is impacting your ratio. So let's talk a little bit about that, right? Because
Yeah.
30% of our score is balance to limit, specifically on revolving accounts. And I've been hearing this for years. Just keep your balance below 30%.
Yes. Hear that all the time.
That's okay. That's okay, right? But let me give you a couple of scenarios, okay? I have limited credit history and I have all tier 2 credit, all
Okay.
right? It's a risk predictor. Because I have tier 2 credit, I'm already in a higher risk class than someone who has tier 1 credit.
Okay.
And let's say I'm carrying 30% balance to limit. I'm likely going to have a score hit from it because I have limited credit and I have tier 2 credit. So I might need to have my balance to limit at 10 to 15%. Hey, Wanda. So that's something that's really important is that your score is personal to you, to the type of credit that you have. So don't get caught up in the generalities. There are guidelines to follow, and that's what I'll call them. There's guidelines to follow,
Right.
but every guideline has a what if. And you're an individual. The way you pay your bills is something that's individual. The type of credit you have is individual. So we're going to go back to annualcreditreport.com and say, pull your credit report, look at it. Who are your creditors? Are they tier 2? So that's okay. Don't think you have to panic because you've got a 0% interest finance loan on your auto. That's
Yeah.
okay. That's using someone else's money to your benefit. But
Yeah.
make sure you've got a MasterCard or a Visa thrown in there,
Yeah.
right?
Now, disputes. So one of the issues that we deal in with mortgages regularly because of the different guidelines, depending on if you're doing an FHA loan or a VA loan or a conventional loan, is when it comes to disputes on credit. And in my experience in dealing with people in their credit reports, what typically happens or what I see happen a lot, and this is what I tell people, and we'll get to credit repair here in a minute, but people that go to some of these credit repair companies, the trick or the move is, and again, please, I've been telling people this for years, so I hope I'm right. But these credit repair companies, they go into your report and they take every negative item, late payment, collection, whatever, and they put them in dispute. And then once they put them in dispute, when I pull your credit, if those accounts are held in dispute, well, that dispute, all it does is it freezes the account. And so therefore the score is inflated in some cases. And the score looks higher than it would actually be if those disputes were removed and that report was included. So like when I do an FHA loan, if I have an account that has an over $1,000 balance on a collection and it's in dispute, I have to remove that dispute, or I have to do it as a manual underwrite. And so, conventional is a little bit different. So, a lot of times just because this account is put in dispute, it doesn't mean that that's helping your score. And there's other little tricks that they do to kind of get you in and pay your monthly fee and whatever. But then the other side of that is that sometimes I have to remove the dispute and that could cause your score to go down. But then what the dispute is, and I think this is where people get a little sideways on this, is they say, well, I've disputed that because, Charter, I returned the box and they said that I didn't, blah, 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 blah. And I say, well, that's great, but Experian, Equifax, and TransUnion are not going to litigate who did what, when, and where. All the dispute is, from what I understand, is this you and your account? If it is you and your account, then it's a valid account. Whether or not the situation was right or not, that's something that you have to work out with the creditor. But at the end of the day, the dispute is nothing but saying, that's not me. Well, if it is you, then the dispute isn't helping you. What do you say about all that?
Yeah. So I'd say you're 100% right giving them the guidance that you're giving them. I will say, yes, 100% right. Yes. If you were applying for a mortgage, disputes on your credit report are not something you want to have. So those will need to be removed the majority of the time, right? People dispute items on their credit report because quite often they're given the wrong advice.
Right.
And having a negative item with a dispute comment on it in some of the score models means that that item is being ignored by the score. That's how they inflate the scores. Okay.
Right.
So remember back at the beginning of the conversation, I said I started working with TransUnion. Well, they had a consumer dispute department, and you would get just bombarded with these letters from these agencies that would dispute the name. It should have a middle initial. So it's not just that they dispute an account or negative information. The trick is to dispute everything on the credit report. There's 30 days for a creditor to respond. And keep in mind that these disputes start with the credit bureaus, but the only one who can change your information is the creditor. Okay.
Correct.
So the information comes into TU in this letter, and sometimes it's that whole story about the box, right? And they're just trying to figure out, like, what are you disputing, right? So the dispute letter comes in, the comment goes on the credit report, the creditor is given 30 days to respond, and everyone knows that the creditor has 30 days to respond. If they don't respond, then the information has to come off the credit report. But did you know that there's also a reinsertion clause in the Fair Credit Reporting Act? And are these agencies that you're paying this money to telling you that if at any time after the expiration of the 30 days that they come back and say, nope, that's right, it'll get put right back in your credit report.
And it's like a new collection too at that point, right? It's not even like a collection.
A brand new date reported, a brand new date of last activity. You've got all kinds of stuff that's going to carry weight in your score. And I think that's another important thing. We talked about time a little bit, about timing of the debt and timing of the credit report pull. But your date of last activity and your date reported, those two dates on that creditor information on your credit report is what makes that account important or not as important to your score. Right. So that's something to think about. If you reactivate something that's negative, that's old, it will pull your score down. Is it being looked at your score today? Yes. But, I always think about, what have you done for me lately, right? It's a great little song, right? So when I'm looking at a credit report and I see that old stuff on there, I'm like, we're not going to do that. Janet said, do not, right? Do not bring that current. So we're not doing it.
That's the problem that happens. A lot of people get taken advantage of with these credit repair companies, is that they go in and dispute everything because that's the game that they play. And then they'll take an account that hasn't reported on their credit for a year, a collection that just it was a $50 medical collection that they just kind of gave up on and stopped reporting it. And then they send it to them and they're like, oh, you're back. Oh, well, yeah, then this is absolutely you.
Not only do you owe it, but we're going to add all these interest and fees to it. So it's not 50 anymore. It's now 500, and it's now, going to tank your score by 100 points. Yeah.
Yes.
It absolutely do not want to do that. So,
and that's why I advise people. I'm like, look, I understand what you're doing with the disputes. I understand the concept of it and what you're trying to accomplish, but more often than not, I think more often than not, it works against you rather than it works for you when you go in and do that.
It can. I mean, there are legitimate disputes,
Sure,
and
sure,
I'll share
absolutely.
you a quick story of a legitimate dispute. So this happened to a prior coworker of mine when I was still with that TU bureau. She and her husband were getting relocated to Hawaii, so they were buying a home. There was information. The home that they owned in Las Vegas was a home that had previously been in foreclosure, but they purchased it, and one of the repositories kept reporting it as a foreclosure in their name.
Oh,
Now,
wow.
this was happening right after the amendments had been passed to the Fair Credit Reporting Act that allowed people to sue for inaccurate information on their credit report. They had a
Yep,
stack this high: dispute resolution, dispute resolution, dispute resolution. They hired an attorney and they were able to sue this repository for the cost of the home in Hawaii that they'd been denied, which was over 500,000 because of this inaccurately reported information. It never got reported wrong again, but they also had a home free and clear in Hawaii. So there are legitimate disputes, and there
sure.
are right, I would say, agencies that will do it right, that will do it to your benefit. And then they're also going to help you build your credit back. If what's happened is truly credit mismanagement, and it happens, I did it,
Sure.
everybody does it. At some point, we were talking about that, these mortgage professionals that didn't learn about credit until they had to fix something really in their own world.
Yep.
So we all learn about it, but let's try and learn about it a little bit earlier. I think that's what your podcast is going to do. So
Yeah.
you can, I'm a big proponent of, if I can take my dirty laundry into a laundromat and have someone take care of it for me, I should be able to hire someone who is reputable and doing business the right way to help me build my credit back. And I think to do that, you want to start with the National Foundation for Credit Counseling and see what options they have. I'm
Yes.
not trying to put anyone out there out of a job that's in the, I'm going to say, credit business,
Mhm.
but I think that there are places that are better suited for getting people set up back onto a good financial footing, because we don't get into credit issues typically without some financial um, empowerment that we need. Let's use that
Yes.
word. Yeah,
Yep.
we need some financial empowerment. So the National Foundation for Credit Counseling is always, I say, start there because they have great resources.
Well, that's good, and that at least gives you a place to go start because I just think, someone finds a credit repair company online, calls them, and then they promise the sun and the moon, and more often than not, when they're doing the disputes, and it's not the individual that's doing it, it's often these credit repair companies, they're doing it for the sake of improving the credit score, not for the sake of correcting something that's not correct on the report, which,
Right.
that's you're doing it for the wrong reasons. If it's something that you're trying to fix because it's incorrect, then absolutely disputes, make a big difference. But if you're doing something, you're disputing an account that's absolutely yours only for the sake of trying to boost your credit score up, it can work against you in a negative way often.
Yeah,
Um,
I had someone who okay, here's got a great question about medical bills. As long as you're making middle payment, well, they've changed all of that, Brad. So medical collections are really have been changed significantly, and we're seeing those changes already on credit reports.
yes.
So medical collections under $500, paid or unpaid, are no longer reported. Medical collections that have been paid under $500 have been removed, and medical collections or medical accounts that could go into collection have a year waiting period before they can go into collections. So they've done a lot. Now here's another advantage for Vantage Score, and no, I don't work for Vantage Score, but they did a study. There's no predictive risk from medical collections. So they have already removed all medical collections from their calculations in the 4.0. And I'd have to double check, but I think the 3.0 has also removed all the account. If it's reportable, could be on there, but it's not part of the score.
Well,
So you
that
have to
makes
remember,
sense. That
yeah,
makes sense just because like you were saying, it's a predictor of if you're gonna default, like your credit
right,
score is basically predicting, are you gonna default on something in the next 2 years? Well, if you have medical collections, because it's such a broad, category, I guess, just because it could be disputes with insurance, it could be something not claimed correctly on how it's set up. So all of those things could impact, in a negative light, something that you had no control over. So, I mean, I think that's at least a good change that they made because we do see that as well. In the mortgage side of things, I mean, obviously to some extent it's reflected in the score, but outside of that, if you have 50 medical collections on your credit report, we don't care. It makes no difference on your ability to get the loan. It doesn't impact, if it's a medical collection, we essentially just pretend like it doesn't exist.
Well, and that's a great thing about the new score models that are coming into mortgage. You guys no longer have to ignore them. They're not going to be calculated in the score, right? So
Yeah.
they just won't, they might be on the credit report if they're reportable. Again, these are some of the things that are coming up under the NCAP, which is part of that suit that removed the public record information. One thing on the medical collections, the majority of people that saw a score increase from the removal of medical collections already had high scores.
Mhm.
The majority of people who didn't see a lift and are still having medical collections are the people that are sub 620 anyway.
Right.
So we have an entirely different conversation around that, where it's, the disparity in the scoring system and in the financial capabilities of the people that fall on those certain spectrums of the scale.
Now, if somebody has actually had, let's say that, my credit's pretty darn good, but I did actually have a late payment for whatever reason. And many a times, we get this a lot with, or we used to, I haven't seen it quite as much lately, but just a good example of it is student loan debt, right? So I lived in an apartment in Lubbock when I went to Texas Tech, and I had my mail sent there. And when I filled out my student loan application stuff, it would have my apartment address for my address in Lubbock. Well, as soon as I didn't graduate from tech. So as soon as I left tech and went somewhere else,
Right.
then now that when the bill comes due, once I've graduated from college and now I'm having to pay those, well, that bill gets sent to the address that they have on file. Well, that address on file is my previous college address that I don't get mail at anymore. So, and if I am a young college student and I'm stupid and I don't set up a forwarding address and all of those things, right? I understand the
Right, right,
responsibility
right,
of it.
right,
But
yeah.
point being is just that the bill's getting sent to the wrong place. So maybe it was, what kind of actual, recourse do I have to either, should I call the credit bureau? Should I call the creditor and say, hey, please, this isn't normal? Like, what would you do in that instance to try to make sure that you can at least try to get that squared away?
Well, I had it happen, so I'll tell you what I did.
Great.
So we had
Not
hubby and I
great.
both had Pier 1 cards, right? We're using the credit to our benefit. So
Yep.
his bill came in, I paid it, my bill came in. I'm like, oh, this is a duplicate, and I tossed it. Okay. So here's Sue knows a score with a late date on her credit report. And I don't call the bureau to complain about it because they're not the one that reported it. It was Pier 1 that reported it. So
Right.
whoever it was that was underwriting Pier 1 when they were in business, I called them and I was like, look, here's what happened. Had two bills. I didn't pay it. It was completely my fault. I'll pay it in full right now. Fall on the sword, call your creditor, ask for a courtesy deletion. If you've never been late in the past, if it was an address issue, the best thing to do when you have something happened to your credit that you weren't aware of, or you overlooked it, is call the creditor. Don't dispute it. Don't go to the bureaus about it. Pick up the phone and call the creditor, and explain to them. And you can often ask, I've done that successfully with mortgage lates where we've had a courtesy deletion because they look back and they said, you know what, this is one time out of 5 years that you've been late. Obviously, it was a one off. And you even have creditors today that won't even report a 30-day delinquency. They won't report until it becomes 60 days.
Oh,
And I
wow.
think on student loans, they're typically at least 60 to 90 days before they'll report the delinquency.
Really? Okay.
So the best thing you can do before you get into an issue, or if you've just gotten into an issue, is talk to your creditor. The last thing they want to do is not get paid.
Right.
They have no benefit in you not talking to them, right?
Right.
So they're going to take your call and they're going to try to find a way to help you.
Yes. Well, and you have to communicate with people, right? You have to, the more you open communications and don't stick your head in the sand and hope it goes away, then the more likely it is that they're going to work with you and help you out. Now, if you've had 25 late payments across your credit report and you've missed there 5 or 6 different times, and now you're deciding you're going to communicate with them, they're probably not going to be as willing to help you out in that circumstance, as they would otherwise. But we all have missteps and we all make mistakes. And, the best thing, like you said, and I 100% agree, is pick up the phone and call them and talk to them. And that's what I advise people. And we've done it multiple times. I've looked at people's credit report and they had like a home equity line of credit that they were carrying, and they had a late payment on it because the husband told the wife to pay it, and then they just totally forgot about it. And then it showed up, and I pulled, I was like, hey, do you know your late payment back in April? They're like, what? How did that happen? And I'm like, they're like, oh gosh, we forgot. I said, just call them and talk to them and say, hey, look, here's what happened. We didn't even know about it because we just figuring this out. Cause don't tell me you're applying for a mortgage, but they just went and did this thing. And so then they'll go look and see. And then I've had it multiple times. And especially recently it seemed like it's even been even a little bit better where creditors are really actually willing to work with people if you communicate with them.
Yeah, exactly. And I was talking to someone recently. Someone was, and I said this in my video yesterday. It was like, I'm in debt. I'm going to take on more debt to try to get out of debt. That's not the process, guys. That's
Right.
not what we need to do. So if you're in debt, call your creditor, ask them to reduce your interest rates, ask them to lower your payments. Most of the time, and I mean 99% of the time, they will work with you to lower your monthly payment. They might give you 6 months or so. They will not hit your score. They will not show you late, but they will if you don't talk to them. So
Yes.
with all things credit, the best thing you can do is start with pulling your credit report. Look at what's there. If you don't understand it, get with someone who does understand it and help you understand what's going on with your credit. If you're trying to build it, go to the NFCC and look for some of those resources that I mentioned, National Foundation for Credit Counseling. There are just great agencies out there. They're not wanting to put you in a debt repayment plan. That's not their goal. They do offer that, but just a lot of options out there. But start with understanding and start with knowledge, and then you'll grow from there.
So, you made a video about this. I saw some the other day, and you may have even mentioned it in that one too. But so, right now in the United States, we have more credit card debt than at any point in the history of our country. It's insane,
Insane.
and delinquencies on credit cards are rising. Delinquencies on car payments are rising. Bankruptcy filings are going up. All these things are starting to kind of pile up on us. So, this is not good things, but these are things that are happening, and you need to be aware of it. So my question is when someone gets to a point where they are able to start paying down some of this debt, okay, and you may not be able to do it today, but that needs to be the plan. From your point of view and dealing with credit all these years, what would be a good route to start? Like, what would your path be? Everybody knows the Dave Ramsey thing of, start with the highest interest and, roll it, snowball it, all that kind of stuff. Like, I think a lot of people that have seen that know understand. And I think there's benefits to that for sure. But from your point of view, when you consider what's going to have the least impact or best impact on my credit score, and then
Mhm.
also what types of debt are better to pay off overall so it doesn't negatively impact you on your score.
Yeah, I think, part of Dave Ramsey, I don't suggest that you start with the highest interest rate. I suggest you start with the smallest balance, because the most discouraging thing you can do is try and start at the top of the mountain and climb up to this is, so let's start at something small, because then you can see the progress. So if you have a balance of $1,000 on a credit card and you're paying a little bit extra on everything, put all the extra on the $1,000, because then you're going to see that paid off, right? Don't close it, just pay it off. And then take all that other extra and put it on the next one, right? I have had friends do this over the years, and they're astonished that in 2 years, thousands of dollars of credit card debt is paid off, right? Now, if they
Yeah.
did it the other way, the highest interest rate, I get it. You're removing that interest. You're not paying extra on the interest. You can
Right.
negotiate your interest.
Yeah.
So, and you want to see that you're making a difference in what you're doing. So that's my recommendation. Start with the smallest balance first, pay it off. Put everything else on the next balance, pay it off. Revolving debt to me is the best place to start, because it's difficult to fast track a car loan, right? They're
Yes.
already $700 a month. Got an extra 700, you probably wouldn't have credit card debt, right? So start with the small ones. And then once all of those are resolved, then do the same thing, right? But you can't take that extra money and go, whoa, I paid that off, I'm going to go do something else. You've got to stay on this path. And then you'll start to see that your credit score will improve. It's not going to be immediate, but it wasn't immediate that it went down either, right? It didn't go
Right.
down in one day,
Yes. Well,
right? So,
sometimes you get that late payment, it'll hit you and it'll, yeah.
yeah, that's it.
That whole
Happen
recency
on the
thing.
30th, yeah.
Yeah, that whole
Yeah,
recency thing.
you can't see that
What
big difference.
you did say, don't close the account. Now, I kind of understand where you're coming from on that, but explain first off, explain why, and then also, if someone's carrying 10 credit cards versus someone that's carrying 3 credit cards, where's
Uh-huh.
that balance of how many accounts you want to open, even if they don't have a balance?
Okay, so I'm not going to talk about count yet. I want to talk
Okay.
about length of time accounts have been established. So
Okay.
I
Yep.
have a credit card I've had for over 20 years. The only thing that's on that credit card is Netflix. $16.77 a month gets charged, $16.77 a month gets paid. That's all that goes on that card, right?
Okay.
And so I have 20 years of credit that's part of my 830 score. That's the biggest reason I have that score, right? I have to keep that card active,
Right.
right? I've got a couple other cards that I've had for 11 years or maybe 7 years, right? They're all major bank. They're all tier one. Okay. I also have a department store card. I use that maybe twice a year just to keep it active. Again, that's a length of time. How many credit cards should you have? So around 5 to 8 is what I've heard. That's a lot of debt to be balancing, but
Yeah.
I have Netflix on one. That's the only thing that goes on there.
Yeah.
I have points cards that have like my power bill and my cell phone bill, right? So everything gets paid on my credit cards, and then my credit cards get paid in full every month because my credit's working for me. I'm not working for my credit.
Right.
So the number of cards should be about 5. You should have a mix between major bank and credit union and department store cards and keep them active. You don't need 10, but if you have some, keep your oldest cards.
Okay.
Don't get rid of the newest cards.
So keep the older ones, keep those
The older
going, but anything that's new, once you get
You're
over
you're
maybe 4 or
safe to
5.
close that, but you're still going to, right? So credit utilization is the entirety of how much credit you have, your limits, if you will, right? And then how much of those limits that you're using.
Yeah.
Having $200,000 worth of available revolving credit is not going to increase your score more if you had 100,000 instead.
Yeah. Okay. That makes sense. So Brad had another question, but we kind of answered this in the beginning, but just go ahead and just restate just for anybody that missed that
Yeah.
part.
So if
Yeah.
they add a child to a credit card, so it's the difference between mortgage underwriting and credit scores. The two do not exist in the same world together, right?
Right.
So we have our credit score, and then we have underwriting to deal with the things that people do with their credit scores. So
Yeah.
yes, I am a fan of an authorized user to establish credit for a child. Okay. Is it weird for a 7-year-old to have a credit report? Of course it is, right? But they're not going to be able to get their own credit until they reach legal age. And most people, especially in the mortgage space, are going to say, you can't count that. That's not their debt unless you can show that they've actually been paying on it. But the
Yeah.
point of an authorized user, just like I did with my brother, is you get them a start. They
Yes.
get a start. And from that start, they can then get their own account. And
Yeah.
that's exactly what he's done.
Yeah. Yeah. No, having those authorized user, and I didn't know, can you add like a 10-year-old to as an authorized user to your account?
They won't report it because they don't have a credit report yet. But I've
Right.
heard people say that they've added, I've actually seen it where you've got credit established under a child. Some of that is in a fraud space.
Yeah. Yeah.
But you're adding your college age student to it. They might be 17. um, to that card. Can you do that? Yeah, you can. They're an authorized user, but they're not going to report it. And if you want them to report on that person's credit report, then they're going to need their name, address, and social security number, and then they'll start reporting it. Not every creditor will report on an authorized user. So if you're looking at that to help someone get a start like I did, make sure you ask the creditor before you do it. Do you report? And if you do, what do you need to report the information on their file? And
Okay.
if they don't have a file, it will be created through this process of them creating a credit report for
Okay. All right. Well, it's another way to get them started. You got to get
them.
them rolling early because, again, necessary evil. You have to do something with it. You can't just ignore it. Last thing I want to get to, well, two things. One is I do want, before we get off, because we're already at over an hour, so I want to be respectful of your time. But this has been great. Let's get back to the credit repair companies or whatever, just because I want you to give kind of if someone was looking or trying to get their credit repair, and I know you mentioned I can't remember the name of the company or the advocacy group.
National Foundation of Credit Counseling. Yep.
Yes. Okay.
NFCC.
So
Yep.
it's National Federation of Credit Counseling to get information there. So I want you to talk about that. And then also, if they reached out to the local credit repair company, what kind of questions would you ask as a consumer to them to say, hey, what are you doing here? How are you doing that?
Yeah.
And then reasonable costs basically for that. Because sometimes, I always tell people you get what you pay for. So if you're paying $100 a month, then you're probably getting $100 a month worth of service, and that's not going to benefit you much. And then we'll get to the FHFA piece here at the very end. But talk about the credit repair companies for a minute.
Yeah. So I think that there's a place for reputable credit. I hate to call it credit repair. I'm going to say, credit building agencies. Okay.
Credit
So
counseling. How about that?
credit repair agencies, please change your name from credit repair to credit building. Okay. So there are some. And what I would do, my recommendation is the CFPB actually has a website that talks about these agencies. They just find a couple who are doing it wrong, and
Yep.
they actually have some questions to ask if you're thinking of using these
Okay.
agencies, and they have some referral sources.
Great.
So I don't want to be a referral source in other than the National Foundation for Credit Counseling. But I think if you go to the CFPB, you can get those answers really easily. And it's simple to search their site. It's just CFPB credit repair. And then they'll let you know what you should look for. There are restrictions about, charging for a service that they have not received. So that was what got some of those very large billion-dollar fines to those other agencies, is that they were doing something against the letter of the law. So it is something that is allowable under the letter of the law, but there are significant rules for those agencies to follow. So CFPB is my referral for that. And what was the other follow-up question, Mike?
Well, okay, so then that's just basically on the credit repair or credit counseling side of things. So we got the questions that we should ask them when we get on there. We can find that on the CFPB website. Is there something that you think is a not maybe necessarily a reasonable cost, but is there a if someone was telling you, hey, this is only $100 a month, would you be like, probably stay away from that one? If someone's like, no, this is actually 1,200, here's what we're going to do, here's how we're going to do it. How do you gauge what makes the most sense for someone that just doesn't know any better?
Yeah, I think I would say check with the CFPB because they do have guidance on that. There cannot be a charge in advance of services. And there cannot, so there's a lot of rules around there, and I'm not as well spoken on those rules, so I don't want to give anyone wrong advice. And that's why I'd say if someone's going to charge you something for something you haven't received yet, um, always be suspicious of that.
Right.
Okay.
Yes.
Just straight up. That's like, I give me $1,200 and I'll fix your credit report. No,
No, I
don't
don't
do
think so.
that. Yeah,
Yeah.
no, don't do that.
Yeah.
Don't sign up for a monthly service when you have no idea what you're receiving. So if something sounds too good to be true, probably is.
Probably is. All right. Last thing is you'd mentioned several times these scoring models specifically for the mortgage industry are changing. Do you know when this is going to occur, and then what is happening specifically with the FHFA on what are they adjusting specifically? And I know we've mentioned a few things, but just to recap some of that.
So they're making some major changes for our industry. The first one is, and they've not yet. Now I haven't checked the website since the NBA, which is when they announced all these changes, was last year at the NBA. But there's two major changes coming our way. We're going from a tri-merge to a bi-merge. And when you go from a tri-merge to a bi-merge, you're going to be calculating your scores differently. It's going to be an average. Now that's today's thought process, but what FHFA has done, and I'm on these calls, is they have opened, and other people can join these calls. I did a post on it. I'll send you the information, Mike, if you want to add it to your feed.
Yeah.
But they're asking for stakeholder feedback, and it's not just the company, it's individuals, right? So first and foremost, the changes are coming. They were supposed to start Q1 2024 with the move from the tri-merge to the bi-merge.
Real
I
quick
think
on that, the tri-merge to the bi-merge.
mhm,
So is somebody getting left out?
that's lender choice right now.
Okay, so we have 3 credit bureaus, Equifax, Experian, and TransUnion. So
Right?
you're saying that the lender, whoever that is, gets to decide which of the 2 that they're going to choose to merge.
Yep.
Wow. So somebody's going bye-bye, right? At
Well,
some
I don't
point,
know if
maybe not
somebody's
right
going
away, but
bye-bye. So
that
I think
that's
there's a lot of controversial conversations around that. Let's say that. And then there's been some studies that I've seen that have been recently um, dropped, let's say, that have said
yeah,
that if you go from a tri-merge to a bi-merge, you just took about 2.1 million people out of the housing pool. So that's one thought. Well, think
yeah,
about it. So rural America,
yeah.
and when I lived in Texas, I was traveling all over Louisiana, some of the areas that had only finance companies, very small banks who may only
Tote the note
report to
car
one
dealerships.
repository,
Yep.
right? So if my credit is only being reported to, let's say, to you and Equifax, but you pull Experian into you, am I going to get a fair shake?
No.
So what I've been asking lenders to do so that we can start to weigh these changes like real life in our offices is take 4 credit reports. What's your current mid? What's your mid with 2? And do those options, right? Because your
Yeah.
average, that's what they're going to look at. They're not going to do a mid anymore. You're going to have 2. So what's your average score?
Yeah.
The idea has been, and what's been published by FHFA, is that the score differences between a tri-merge to a bi-merge is no more than 10 points, but that's not actually 100% accurate because there is a large population where it's more than 30 points. So how do we
Right.
manage that? How do we manage that? So that's part of the conversations. They want feedback, they want information, but we're supposed to be getting some of the data that they did, the research that they did on Vantage 4.0 and FICO 10T is supposed to be released in Q3. So I'm hunting for it daily to see if I can find it and then share it.
Right.
So that's one change. Bi-merge to tri-merge, same score models. Now here comes the next change. I don't want to be a mortgage lender explaining this one.
Uh-huh.
Here comes FICO 10T, here comes Vantage Score. Your credit report will display and will provide an explanation, a score disclosure notice for 3 scores. You'll still be using the old models until 2025.
But you're
That's
doing a
supposed to start
bi-merge, but then you're showing all three.
by merge, but each borrower will have 3 scores. So,
Huh.
yes.
So yeah,
Yeah.
that's going to be a difficult conversation.
Yeah, yeah. So, hey, Mike, it's not just that my, FICO 8 score is 659 or my Credit Karma score is 659, but my Vantage is 700. My FICO 10T is 658, and my 20-year-old FICO model is what you're going to write my loan on. I'm not happy with that.
Yeah, let me ask you a question on that then too. Is there a scenario, because it sounds like there would be, where somebody let's say you're a lender and they call you, right? And you're using Equifax and TransUnion as your your buy merge score, okay? And they have a whatever, 700, okay? Then they
Average
call
score.
me and I'm using Experian and Equifax as my buy merge score as a separate, I'm a different mortgage bank, right?
Mhm.
And when they call me, their credit score is 730. Okay. Well, that 30-point difference moves them to the next tier. And now they're going to get a better interest rate because I'm using the different scoring model than you're using. Because right now,
Well, you're
the
using
bank,
the same score models, but you're using different
yeah,
repositories.
different
Yeah.
bureaus. I'm sorry. Yeah, different bureaus on that. So right now, it's a level playing field. Like if you, from at least from what I understand, if someone has their credit pulled with me today and they have their credit pulled with you today, we're going to
Mhm.
have the exact same 3 scores. Assuming there isn't
Pretty
anything
close.
reported in that whatever.
Timing. Yeah,
Yeah,
timing.
fine.
Yeah.
So, but now, if this change occurs, then depending on what bank, on the bank that decides to use which repositories they decide to average,
Mhm.
they could have a higher score with one bank than the other. Is that right?
That's true. And there's been a lot of thought process about, well, just pull a soft bureau, pull a prequel soft, right? Pull
Yeah.
all 3. Pull a prequel soft, and then pull the 2 on your hard that are the highest.
Oh, so
Now,
you could, as a lender, you could have either model or 3 different. How many models would there be? 1, 2, like
well, if
3
you
or
pull
4?
3 hard, right? If you do a regular standard mortgage pull, which is a hard inquiry, you pull all 3 bureaus, you'll be forced to use those 3 bureaus and
Correct.
the old way.
Right.
Okay.
Yeah.
But there's some conversation around maybe I just pull a soft pull, all 3
Right.
bureaus, figure out who's the 2 highest, and that's who I pull. Okay.
Yeah.
Now that's a great strategy. If I was still originating, that's what I'd be doing,
That's
right?
1000% what I would do if that was the
Right? I
case.
don't
Yeah.
like you're gonna be getting your prequels all set up tomorrow. I know it.
Yeah.
So now there's some thought process though, but what if, because score models were supposed to remove any idea of, prejudice.
Right.
So what if somebody goes, okay, I got my prequel soft, but yeah, I'm going to use these other 2. And they don't pull the 2 that are the best to the consumer. Now, why would a lender do that? I don't know. But that's some of the conversations that and questions that's being posed to FHFA and saying, how do we monitor this?
Yeah.
How do we ensure that the consumer, because these changes are supposed to be for the benefit of the consumer,
Right.
how are these changes going to benefit the consumer? How are we going to know that lender 1, lender 2 are giving the best option? The other thing that FHFA has said and has been very, very adamant about in these changes is that these changes are to force competition amongst the repositories.
Which I think is great. I think that's fantastic.
Yeah, who's got the bigger data, because that's really where these guys compete. Who's got the
Yeah.
most data, right?
Yeah.
So who's got the most data? Who's got the best system for delivering information and data, right?
Yeah.
And then we're talking about competition amongst mortgage lenders. I'm simply happy that we're going to have 2 score models coming out in 2025 because we've had since 1995 a choice of one,
Yeah.
and that's the only thing in our mortgage industry that we have only one choice on.
The whole credit games, it's a racket, and
It's a game, right?
it is great that we have people like you, Sue, that are, came from the inside, that know all this stuff, because it's so incredibly confusing, and it's unfortunate because it has such a heavy weight on everything that we do, especially because, I mean, good or bad, we are a debt-based society. That is what we are. Our government operates at a deficit. Most people operate at a deficit. I
Hardest
mean,
ever. Yeah.
yes, I mean,
Yeah.
again, I'm not saying it's good. I'm just saying it is what it is. And it's one of those things that your credit report and your credit score and all that impacts has so much, impact on our life. When I made the promo video for this, I was talking about how, like, this is something that literally can save you thousands of dollars a year in interest that you pay to
Absolutely.
your debt if you have it managed correctly. And
Absolutely.
that's, for some people, that's a month's worth of pay, or, more so. So it's just, it's so impactful to people. And yet it's such a complicated thing. Very few people fully understand it. And, those of us that work dealing with credit every day, I do mortgages, but obviously I deal in people's credit report every day. So I need to know this stuff because I have to be able to explain it to people, because we're the ones on the front lines really kind of explaining this. They don't get to talk to you,
Right.
and have a conversation with you and people like you all the time. So loan officers and even real estate agents, who are, my primary audience here, these are
Right.
things that we have to know, because we have to be the ones on the front line educating our buyers and educating the borrowers on what they need to do and what impacts their score and how to go about it, so they don't have to go pay some, person that's probably not looking out for their best interest to give them bad information and do bad things that's really ultimately going to hurt them.
Right.
And, it's incumbent on us to get as much information, as much knowledge as we can, because we're the ones that are the primary educators in most of these things when it comes to the consumer.
It's true, Mike. And I think, it's funny. There is nothing interesting about having a credit conversation, right? Unless you need credit. That's the
Yes.
only time that it's interesting. But I
Yes.
am working on creating some resources and some places where people can go and easily grab information and data that, as a real estate agent, they can provide that. As a loan officer, they can provide that. So, look for kind of the next step of Sue Knows Score is to kind of expand a little bit out of LinkedIn. I've had a number of mortgage professionals that have said, I need to have something that is easily explained in the way that I try to deliver information as easy as I can to make a complicated situation easy.
Yeah.
So look for that coming up. Hopefully in the next 60 days, I'll have that information up and running, and you guys can grab what you're looking for. Like, how do I explain inquiries?
That's awesome. I really, really appreciate it too. We're a whole hour and 20 into it. It was the longest one I've done in a little while, just because it's chock full of information and we could probably go on for another hour too. So I definitely want to have you back sometime in the near
Sure.
future, to kind of revisit, once some of these scoring models kind of really come into play and see how they're impacting things. And then, of course, once you get all your stuff ready to go and get it out there to professionals like us, so we can really educate ourselves further, so that we can carry on that education to our buyers, because especially with interest rates being through the roof right now, maximizing your credit score is really going to make a big financial difference in a lot of people's lives. So,
Absolutely, and it can do it in less than 30 days. So
yes.
there is hope. You just got to
Yeah,
know the rules of the game. Yep.
that's right. That's right. Well, thank you so much, Sue. Thanks for coming on and being with us today. I appreciate everybody that stuck around. Thanks for all the great questions. We will. I'm actually changing up my publishing schedule a little bit, so this will actually go onto Spotify and Apple tomorrow. I do a weekly update now for the market news is generally that I publish on Monday these days. So I'm kind of switching things around, but this will be published on Apple and Spotify tomorrow. So if you want to check it out, download it on those platforms and re-listen to this, because you're probably going to need to go through this. I'm going to have to go through this a couple more times, make sure I get all my notes correctly, because there's just a ton of information in this one. So thank you so much for your time, Sue, and thank you for everybody that stuck around, and we will see you next week.
Thanks, Mike.
All right.